Hello, welcome to this presentation on the dividend discount model. The dividend discount model enables investors to develop an expected returns for the stock market and is based on the theory that the stock is worth a discounted summation of all its future dividend payments, which is a fair assumption to make, as the higher the dividends, you would assume that it's more appealing to investors, therefore investors invest in those stocks with higher dividends, thus increasing the value of that stock. Formally, what we can see is that the intrinsic value is based on the expected dividend payments divided by 1 plus the required rate of return. And the required rate of return will be higher if the stock is riskier. This is because the investor believes they should be compensated for the increase in risk they have to bear. And secondly, what we can see is that it's also determined on the final sale price of the stock. However, if that final sale price of the stock approaches affinity, we put this as transversality condition to say, okay, that equals to 0, because if we set dt to 0, then we would still have a positive value for the intrinsic value, therefore saying dividends don't actually play a factor in that stock's valuation, which may be true for some of the stocks that don't actually pay out dividends. So based on this assumption, then the intrinsic value of a stock is based on the expected dividends. Obviously, as that increases, the value of the stock increases, and the required rate of return. As that increases, that decreases the value of the stock. So now looking at constant growth in the model, what we can see is that now we're going to add in this growth rate. So it's expected returns plus the growth rate of that dividend, and that's going to be constant. And what we can see, we have this neat equation which basically says that the intrinsic value of the stock is based off the expected return, the expected dividend. So as that increases, then obviously investors are more likely to look at that stock and invest in, which increases demand, hence increases the value of the stock. Assuming that this dividend increases higher than other similar competitors. Secondly, it's also dependent on the required rate of return. Obviously, as this increases, then investors see that this stock is risky, hence need to be compensated, and therefore the intrinsic value slightly decreases because of the whole because investors see that the risk is quite a negative, assuming they're risk averse. And then finally, the growth rate. So as the growth rate increases, what we can see is that the intrinsic value of the stock will increase. That's a fair assumption to say, because obviously investors will see that the growth rate is high, and see that the future dividends payments will increase, and therefore it's going to look appealing to an investor wanting to maximize their returns. However, this only holds when the required rate of return is greater than the growth rate. This is because if the growth rate is greater than the required rate of return, then you will see infinite increases in the dividend, which in real life isn't true. And also, over a whole life cycle, it's highly unlikely that the growth rate will stay constant over a lifetime. And this is seen in literature as some studies in the life cycle of businesses undertaken. For example, Koller et al. Discover companies earn a higher return than their cost of capital for a time until their competitive advantage weakens. So obviously, competitive advantage weakens. Investors see that it's looking less desirable to invest in your stock as the profits erode. As if you look at a normal market competition, as more competitors enter the market, obviously the profits erode and you end up with normal profit. Miller and Friesen studied the life cycle of firms and found companies spend in growth, maturity and viral for at least 10 years. So obviously there are different levels of growth here that firm, and obviously profit levels are going to fluctuate. So a constant growth rate doesn't seem like a fair assumption, in the real world. And obviously, Morris 2009 found only 50% of new firms last past 10 years. Therefore, is constant growth in value of stock for new firms valid? Because obviously, it'll carry on growing maybe for the first 5 years, then you see maybe a taper off as that firm is slowly dying and essentially ceases past that 10-year life cycle. So now this is where it's useful to include multiple growth rates, and now we're going to see how that impacts the model. So looking at what Miller and Friesen and also Miller, you can see that obviously adding multiple growth rates seems a reasonable assumption to make, and this assumes that in the first period we see that the growth rate is greater than the required rate of return in the first period, and then in the second the required rate of return is greater than the growth rate. So we can see that the exponential growth in the first few years of a company, or first so ever long, and then it slows down, which makes sense for some firms, especially for what Morris found about how startup companies tend to struggle past that 10-year life cycle. So as you can see, now we have the model now incorporating growth rate 1, where G is greater than K, and growth rate 2, where K is greater than G. And this, I'd say, makes more sense in the real world for understanding the intrinsic value of that stock. So looking at dividend discount model, it says that when dividends fall, then the value of the stock falls. Well, in truth, that isn't always the case, and this is because investors are also interested in the growth rate, because obviously they don't want to invest in a stock now and then see that the value of the stock decreases in the future, and therefore they see a loss. Therefore, they want to be invested in stocks that have potentially high dividends now and also are on the uptrend in growth, therefore have high earning potential. So looking at one way investors can look at this is the PE ratio. That basically looks at the earnings of the firm divided by required rate of return plus the PV go, which is basically the present value of growth, and that's greater than 0 if the net present value of the projects invested are positive, which is good to the investors, because if it's positive, that means it shows that the firm is investing their money in the correct things to help them grow. So obviously, as PV go increases, we can see the PE ratio increases, therefore the growth opportunities are higher. And obviously the PE looks at the ratio of the firm's value due to growth versus due to assets in place. So the higher the PE, the higher the growth opportunities, so the better investment op for the investor. So in other words, we can look at the PE ratio, looking at the earning retention ratio, so how much of that investment they hold back to reinvest, divided by required rate of return minus that earnings retention ratio times the return on investment. And as we can see, as return on investment increases, this increases the whole PE ratio, therefore higher growth opportunities, better for the investor to invest in. Secondly, we can look at the market to book ratio, and obviously this looks at the share price divided by the total assets minus total liabilities. So if total liabilities increase, this reduces the new book value per share and therefore increases the market book ratio, indicating that the stock is overvalued. And that is because obviously that firm is holding a lot of debt, so it's a high risk stock. So obviously, again, that the firm could increase dividends artificially to try and incentivize investors. However, the stock value could actually fall. Looking at this side, because obviously investors see that this company probably cannot carry on with those dividend payments. So looking at what Khan and Irfan discovered, that P ratio and MB ratio were weak in understanding the change in stock market return in the Karachi stock market, thus suggesting other factors other than future growth earnings play a factor in the stock prices. Also, Barbara Bhatt et al. 2010 concluded that inflation base rate all are factors in the stock price. Even if dividends don't change or increase, a firm's stock price may be negatively impacted by market risk. And if we look at the KPM and the security market line, that would indicate that is an efficient stock, because obviously the price should only really reflect the actual market risk. So thank you for listening, and here are my references.